Hey everyone. So today we're talking about the income fund that is taking Canadian income investing by storm, and that is HHIS.to, Harvest's Diversified High Income Shares ETF. It's tech, it's covered calls, and it's got stupid yield. Now, is it good? Is it bad? Will it survive a bear market? Well, stick around and find out with me. But first, give this video a like, subscribe to the channel, and let's get into today's content. Now, for those of you that don't know me by now, hi, I'm Patrick. I've been an investor for over a decade, an option seller for about 7 years, and I've been investing in crypto for 7 years as well. I've grown my portfolio to over $250,000, and I run a little school community by the same name as this channel. This is the best way to support the channel, so if you want to go check that out, link is in the description below. Now, launched in 2025 and already rocking over $1.2 billion in assets under management, HHIS holds semi-diversified exposure to trending tech powerhouses like Nvidia, Tesla, Microsoft, Amazon, Eli Lilly, Coinbase, Strategy, Palantir, Meta, and many more, all wrapped in covered calls and some modest leverage for that extra juice. And if you know this channel at all by now, you know how much we like some extra juice in our cup. Now, if you're chasing serious monthly income without selling your soul to boring index funds, HHIS might just be your new best friend. But there is a caveat, a little sprinkle of asterisks that we will just discuss later in this video, so stick around for that. But first, let's dive into the fund and see how it has been performing against my other favorite covered call funds that I've talked about before on this channel. Now, to preface this video, I personally have not started a position in HHIS yet. However, I have talked about it in a recent video and that I probably will start building a position in this fund, but that most likely won't be until the next bear market because I am loaded up to the gills in risk at this point of the market cycle, and frankly, I just don't need any more positions in my portfolio to manage. And I'm starting to come around to the fact that this will probably be a fund I will have to manage actively and not hold passively for long periods of time. So consider this video more like a personal video journal of how I look at funds before I decide to start investing in them. Now, first, let's talk about the yield, because that's why we are all here as income investors. 25% yield. Yowza, 25%. That's a dirty number in the income space. That number will definitely turn heads and get the financial advisor bros up in arms telling you it's a scam and that it's probably going to hurt you in the long term, and to an extent, at least temporarily, depending on when in the business cycle you buy it, they may be right. This fund is tech centric, so volatility is to be expected, and if you get into this fund at the right time and diversify your distributions into more safe and longer term conservative funds like HDIV or index funds, you probably can outperform general boring index investing. But enough with all the blabber, let's just get right into the results. Now, in this chart, I included HHIS, HDIV, QQCL, HYLD, and ZWT. Now, HDIV, because it is my personal golden standard income fund, and if I'm honest, I have yet to see many income funds beat this one over long periods of time. And then I included HYLD, QQCL, and ZWT because all of them have some level of technology exposure, some more than others. Now, if we compare all these funds in an apples to apples fashion, we have to start tracking total return performance from the fund with the most recent inception date, and that is HHIS. So this track record starts from only January of 2025, so pretty limited data in my eyes. So just about 1 year. Now, some caveats. Tech saw massive drawdowns in the April 2025 tariff tantrum, and to this day, most of these funds are still recovering from it, as you can see here. And there are a few crypto-heavy stocks in the HHIS bucket, and as we all know, crypto has not been a good asset class in 2025. I believe we still have about a year left in the bull market, so I fully expect some of these tech stocks in HHIS's basket to perform very, very well moving forward, especially the crypto-centric ones as they play catch-up. And some that are in HHIS's basket that I do not particularly like long-term, like Reddit, Netflix, Apple, and Microsoft. Now, why don't I like these specific assets in HHIS? Well, Reddit is a dying community that has been politically aligned in one specific direction for many, many years now, almost to a level of extremism in some cases, and actively alienates all other Redditors. don't have the approved political opinion, you will be ostracized and probably banned from the platform if you voice your opinion. And I just don't see a business model that works long-term based off of this type of favoritism and blatant censorship. I personally haven't used Reddit since like university, which has been a long time. Now, Netflix. I haven't necessarily become a bear on Netflix, but I just do not like the direction they're headed in as a business. Trying to squeeze more money out of customers because they can't acquire more. The selection of movies are a joke most times. If you don't watch movies through the dedicated Netflix app on your television, that steals all of your data. Your video quality suffers, and that is intentionally by design. There's an amazing video on this actually by a very prominent tech YouTuber named Louis Rossmann, titled "Piracy is Completely Justified. Lewis Tries Netflix and Remembers Why." And then some other recent stunts that Netflix has pulled that puts a sour note in my mouth, like when they force Netflix accounts to be IP locked to one household. Like when they force Netflix accounts to be IP locked to one household, again, to force more subscribers. When companies do this to squeeze every last dollar out of their existing and loyal customer base, instead of innovating or offering a superior service to grow the business and attract new customers, it's a sign of decline that is trying to be swept under the rug. Movie streaming in general has just been absolute garbage these last few years, and prices do nothing but double and triple out of nowhere for less selection, more nickel and diming customers, and ads on paid services. Absolutely a no-no. The gap between streaming services of today and the cable television of yesterday are getting smaller and smaller. For most people these days, you are paying as much for all your streaming services combined as you were paying for cable 15 to 20 years ago. Just a terrible industry. Next is Apple. Apple, I think, has run its course. It has had a great run, but the products are, again, not changing much iteration to iteration. Prices for their phones are becoming absolutely insane, pricing many people out of the market and making their market share smaller and smaller. And Apple has dumped a ton of money into AI recently, and they have completely fallen behind the bleeding edge. And it seems that their competition continues to grow market share while Apple does not. I don't know if anyone watching this has tried Apple's AI, but compared to ChatGPT, Claude, or Grok, it's embarrassing. Again, not a bear on Apple. I just think that the major gains it once made are gone. I see it as more of a stable stock that grows slowly but consistently over time, not a tech powerhouse like it used to be. And now Microsoft. Microsoft, similar to Apple, hasn't innovated in ages. The only reason they continue to make any money at all is because the product market they play in has sticky customers, and sticky customers stay around for a long time, even after products get bad. But that also leaves a lot of room for disruption, and when Microsoft loses these sticky enterprises, their business model collapses. And speaking of disruption, Elon Musk has launched a company called MacroHard, a play on the Microsoft name, which its sole mission is to make better Microsoft products and put them directly out of business. And last thing I want to do is to be investing in a company who Elon Musk has his crosshairs on. That never bodes well for his enemies. Again, I like to think, like all other tech stocks, these will go up in value as liquidity gets jammed into the economy moving forward in 2026 and the dollar continues to get devalued. But relatively speaking, I see these struggling at the back of the pack. The weakest links in the HHIS bucket, in my opinion. Now, again, this is just my opinion. You may have other ones, but these are just some of the nuances that I think about when researching funds to hold personally. Now, with the negative Nancy opinions out of the way, going back to our performance chart, our golden standard fund, HDIV, leads the pack. Not a very tech-heavy covered call fund, so it was not affected by the tariff drop as much as some of the other ones, but HHIS trails behind in second place. And to be honest, compared to the other tech-heavy funds in this comparison chart, HHIS has performed the best coming out of that massive tech drawdown in 2025. QQCL performing the worst, and ZWT and HYLD fighting somewhere in the middle of the pack. Now, I would really love to see more backtesting data to see how how HHIS does long-term, especially during a bear market. Because as I've mentioned before, HHIS is super tech heavy, is not super diversified, and so risks big drawdowns during a bear market, which is why earlier in the video, I mentioned that it probably will never be a long-term hold for me. I would definitely be looking to get in and get out of this fund, depending on where we are in the business cycle. I would not want to hold this through a bear market, that's for sure. I honestly wouldn't be surprised to see like 60-70% drawdowns in a bear market in this fund due to the sole fact that it is tech heavy with a sprinkle of leverage. And we all know when liquidity dries up at the end of a bull market, speculative and tech heavy names like the ones in this basket are affected the most. So HHIS, in my eyes, at least for now, until a bigger track record is available, is a covered call fund that I would invest in on a business cycle basis. Definitely not a long-term buy and hold forever through every bear and bull market, which is not to say that HHIS is inherently a bad covered call fund. I think it's good, but it's only good in times of increasing liquidity. I think it will be one of those funds that performs very poorly in a bear market, but excels heavily in a bull market, because there are some really good names in there that will do very well moving forward. Now, please tell me what your thoughts are on HHIS down in the comments below. I'm really curious as to what you guys think of this fund, or if you don't want to chat, just leave a little rocket emoji in the comments to let me know you made it this far in the video. HHIS, in my eyes for now at least, is a covered call fund that you have to time to have very good results in. Again, I could be completely wrong, but HHIS has no historical performance in a bear market as of yet, so everyone's guess is as good as mine right now. Now, if you have stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here, where you can take a look at all the other content I have to offer about investing and my personal investing journey. That's all for me today. I'm Patrick with Apex Wealth Collective. Take care. Thank you for watching, and I'll see you guys in the next video.